In this lesson, we'll introduce you to the concept of beta, one of the main pillars of the capital asset pricing model. Beta helps us quantify the relationship between a security and the overall market portfolio. Please remember, the market portfolio comprises all securities in the market, securities with low expected return and low risk, and securities with high expected return and high risk. If there is a crisis in the economy, it is reasonable to expect the prices of most assets that make up the market portfolio will decrease, and the market portfolio will experience a negative rate of return, say minus 5%. Investors can't protect themselves through diversification because this is systemic risk. Okay? However, some securities in the market portfolio are less risky. They have a lower standard deviation and will decrease less than the market. For example, stock A is less volatile than the market portfolio and will lose only 3%. On the other hand, certain stocks have a high level of volatility and perform bad in times of crisis. And that's the case with stock B, which will lose 7% of its value. When the economy recovers from the crisis and flourishes, the market portfolio will do well and will earn 9%. Stock A, which is a low-risk, low-return investment, will earn its investors plus 5%, while stock B, which is the riskier stock, will earn plus 12%. Okay? This example allows us to see that stocks can have a different behavior regarding overall market performance. Some stocks are safer and will lose less and earn less than the market portfolio, while other stocks are riskier and will do well when the economy flourishes and will do poorly in times of crisis. And that's precisely where beta comes in handy. It allows us to measure the relationship between a stock and the market portfolio. Beta can be calculated as the covariance between the stock and the market divided by the variance of the market. It measures the market risk that cannot be avoided through diversification. The riskier a stock, the higher its beta. A beta of 0 means the stock has no relationship regarding the market. Stocks with a beta less than 1 are called defensive, because if the market does poorly, these stocks will typically lose less. Stocks with a beta of 1 will perform in the same way as the market does. And finally, stocks with beta higher than 1 are riskier than the market and do better than the market when the economy flourishes and lose more when it goes down. The idea of beta is confirmed in real life. Some companies, such as Walmart, are less dependent on the economic cycle. Their clients must buy foods and household products. They might spend a little less, but they can't give up food, right? Okay, and what about car makers? Are they going to be affected by a recession? They will be. People have less money and will drive their old vehicles longer. Car producers can expect a significant slump in revenues. This illustrates how a recession can have a different impact on different businesses. And what about the beta of the two companies? Walmart's beta is 0.09. It is almost independent of the behavior of the overall market portfolio. Ford's beta is 1.1, which makes it a riskier asset. At the end of this lesson, we should remember the following. Beta is a measurement that shows us how risky an individual security is regarding the rest of the market.